I'm Alex Mozet, and welcome to Winner Take All, where we talk about the constant battle between large tech monopolies and traditional incumbents. Today, we're going to talk about a couple IPOs that have come out. We've got Airbnb and DoorDash that have just recently IPO'd, and we're going to look at their stock prices and dig into, is there good value there or not? So let's take a look at, to start off here, Airbnb. So Airbnb is, I think, hovering now around $145 a share, as you can see here, which is up over $76 from where the stock opened, over 100%. So is this too much? Well, there's a couple things to look at. Let's look at Airbnb's S1. This is what Airbnb came out with, when filing with the SEC. And look at these numbers here. So there are 28 days. These are 28 million nights booked is how Airbnb tracks this. And many of their competitors, like a Booking.com, does as well. So you got 28 million in July, 26 million in August, call it 24 million in September. You can see their numbers in Q4 of 2019 were actually much higher, 28 million being the lowest number, right? So you had that number in July, but then it started to go down August, September. They're telling the story that they're bouncing back. But, the question is, well, is that actually the case? Or is this thing overpriced? Let's compare this with Booking.com. Here's Booking.com third quarter earnings release here. You can see 127 million nights booked in Q3 of 2020. Right? That went down to 28 million in Q2 of 2020 and was at 124 million in Q1. So let's just compare that against Airbnb's numbers. So you've got about, call it, 78 million in Q3 of 2020 for Airbnb, and you got 127 million for Booking.com. Q2 Booking had 28. Airbnb had more. They had about 50 million in Q2. Q1, kind of before really COVID hit, Airbnb had about 89, 90 million. Q1 of 2020, Booking.com had 124 million. So obviously these businesses are really valued on growth and the trajectory of growth. So is Airbnb going to be growing more than Booking.com? Booking.com has different inventory. Booking.com has a lot more hotel inventory than they do from the user-generated kind of, peer-to-peer type of model that Airbnb has, right? So they're not apples to apples, but they're certainly much closer than comparing Marriott to Airbnb. Right now, Airbnb is valued more than Booking.com. Booking.com has an $86 billion valuation, and Airbnb, I think, is hovering around $100 billion based upon this share price of $144, $145 a share. I mean, if you just look at it on the surface, again, Booking.com, they monetize those nights differently than Airbnb does. It's kind of a lot more hotel than user-generated, kind of peer-to-peer sharing, right? In the home that Airbnb is. They have different growth profiles of the business. But to me, Airbnb just feels high. You look at where they were valued in the private markets, right? They were valued in the low 30s of billions of dollars going into 2020, right? So in 2019, they had low 30s. Then they went down to the high teens when they had to take this money quickly because of COVID from some of these private equity financiers. So how do you go from 32 to 18 to 100? Greater than booking. If we're solely just looking at nights booked, even the nights booked don't even line up, right? And then you look at booking.com. Booking.com does other stuff. They've got rental cars in here, which is small. They've got airline tickets in here. It just seems high to me. And we don't know the full picture of Airbnb, right? We don't. It's actually much harder when you look at Airbnb's S1 to kind of get a much stronger kind of apples to apples comparison. I would wait a quarter. Let's see how Q4 for Airbnb does, right? Let's see how Q4 of 2020 lines up against Q4 of 2019. You look at booking.com here, right? You look at their year over year growth. They're growing at 10, 11, 12% year over year. You look at these quarterly growth rates here in nights sold. It's not bad. It's not bad growth. I mean, it's decent growth. It's not amazing growth. It's decent growth. And if anything, I think what we are seeing is that the COVID and pandemic has prevented an opportunity for the bookings and the Expedias to move into more of Airbnb's territory. So there's still a lot of unknown with Airbnb. I wouldn't say it's as sure of a bet as DoorDash. And that is the next one here. So Airbnb, I would just wait a little bit. It's hot. It's too hot. It's too hot for me to touch. Personally, if right. It's a platform. Eventually, it will definitely be in plat when there's a rebalance and all that kind of stuff. It definitely fits all the platform criteria. But again, I'm actually thankful that plat isn't rebalancing anytime soon because, plat including Airbnb at $145 a share. That's probably going to come down a little bit. I would wait. To kind of let the dust settle. Let the fervor settle. Let the hysteria settle. It's just too aggressive right now. That's Airbnb. DoorDash is a little bit of a different story here. DoorDash, I had generally a very positive overview when analyzing their S1. $7.25 billion in GMV for DoorDash in Q3 of 2020. Look at this growth, right? It's 3.5x from $2 billion in Q3 of 2019. Okay, that is bonkers growth. It does not fully check out with some of their other claims where they're talking about October. We showed the numbers that DoorDash said in October of 2020, they were the largest food delivery platform in the United States. Bold claims. I'm going to line that up against Uber in a minute here. This is the chart I'm talking about. They're saying October 2020, we did 50% in the category. And then, between Uber Eats and Postmates, they're doing like 34%. I don't know. I don't know about this stat. I do give DoorDash a lot of credit for what they've done. But let's look at Uber's numbers. Here's Uber's Q3 earnings. Look at these numbers here. This is their ride sharing, $5.9 billion in GMV. And then below that is delivery. That's going to be Uber Eats. That's $8.5 billion. You can see ride sharing tanking and food delivery spiking. Makes sense. So $8.5 billion, 134% increase from Q3 of 2019. So not your 350% increase. Okay. And then you had a 53% decline on the ride sharing. And net, they had an overall decline on GMV for 10% decline. Okay. But 8.55 billion in Uber Eats is not the same thing as the 7.25 that DoorDash had. Now, I assume that discrepancy is from Uber being global, Uber Eats being global and having multiple international markets. And we don't really know exactly what the split of this GMV, this 8.5 billion is in the United States versus other markets, right? Whereas DoorDash is pretty much exclusively just in the United States. So that's where I take the discrepancy to come from. It's interesting why they reported that on October versus rather than September, where, we don't know how Uber is doing. How do they know how Uber is doing? They're clearly getting a third-party data source to help them infer what people are spending. You can get these like firms that track credit card spend, and then that's how you kind of extrapolate what DoorDash is doing versus Uber Eats versus Grub versus Postmates. But still, nonetheless, bold claim, DoorDash, hey, we're the biggest US food delivery platform, bigger than Uber Eats and Postmates combined. Hasn't closed yet, their acquisition of Postmates, but still, even when that closes, they are saying that they would still be bigger. Interesting, right? So DoorDash stock is at $186. It's right around a $59-60 billion valuation. Uber's at $96 billion. Okay. Clearly, Uber has food delivery and ride sharing. And, again, the $8.5 billion that Uber Eats is reporting in Q3, you got another $1.25 billion, $1.3 billion in extra GMV on DoorDash. But again, we don't know the exact split of the international breakdown there. But still, if you say, well, if DoorDash is at 60 and Uber has another, 20% of volume on where DoorDash is, then is that another 20% of value? So if they're at 60, should, Uber Eats value be at 70? And then what do you put the $5 billion and change of ride sharing value at? If you're tracking on these GMV multiples, these guys are saying, yeah, if you annualize that, if they're doing say $30 to $35 billion in food delivery GMV, and you're prescribing a $60 to $70 billion valuation, you're somewhere like a 2x GMV multiple, which is high, very high. And if you give a 1x GMV multiple to ride sharing, this is just back of the napkin, okay, guys? And you annualize where Uber ride sharing comes out. If you just take the 5 billion and change, you got 20 and change in GMV. So yeah, you get if you're given a 2x GMV multiple to the food delivery, you give a 1x to the ride sharing, you kind of get to the 95, you kind of get to the 60 on DoorDash. And I'm not saying this isn't exact math, right? But my point is, back of the napkin, the numbers fit a lot better on DoorDash than they do on Airbnb, right? And again, the ability to monetize, well, what are your margins? What do you take down from revenue off of GMV? What's your take rate, right? All these other things. It all goes into it. What's the growth? I mean, the growth on DoorDash is insane, but Uber Eats also had great growth, right? Over 100% year-over-year growth looking at the Q3 of this year versus last year. If you were to buy one and you say that a lot of it, a lot of this kind of comes into saying, well, what's the rebound from COVID? Tree Tran, partner at Applico and former co-founder of Munchery. He raised over $100 million for that business, kind of marketplace for food meals. He was quoted in that Bloomberg article about DoorDash and what happens with COVID. So, is this insane acceleration of digital ordering, digital food ordering, is that trend line going to stay the same, or is that going to claw back a little bit, right? If you look at 21, I think there's going to be some clawback, right? Because literally right now, many restaurants, you can only do takeout. And if you can sit in, it's maybe 25% capacity. I mean, just the dynamics that you have for food delivery literally couldn't get any better. So, to me, it's much harder to say, if you're doing 7.25 or if you're doing $8.5 billion in food delivery GMV, can you just annualize that forward? I don't, that feels much tougher to me to do. I think you're going to have some clawback. Doesn't mean that you're going to retreat to pre-COVID levels. I think you got a lot of behavior change here. I think you got a lot more adoption by restaurants. I think, just a lot of these behavior changes will stay, but you're also going to have people want to go back to eating in restaurants. When you bring that optionality in, you can't expect that everyone, that you keep the same level. There will be growth and these platforms are growing, but again, these businesses are valued on their growth. These growth rates aren't going to remain the same. And I think you are going to see, I think a 2x GMV multiple on that annualized GMV. If you take the 8 or the 7 and annualize it, right, to roughly, above or below a little over 30 billion in GMV, it's just high. It's a very generous multiple. I think if you wanted to be more cautious, you probably could wait a little bit on. I think in general, the markets are just high. In general, platforms are just, they're untouchable. I mean, when you look at Platts performance, we've literally beaten every other tech index in the space. IYW, QQQ, which is the NASDAQ 100. You name a tech index, and we've probably beaten it. Year to date, this thing is up 52%. It's insane. Since inception, 70%. 70%. In general, that makes a ton of sense to me, right? Platforms, the most dominant business model of our time, the strongest business model of tech companies. They retreat less in a recession or in a downturn, and they bounce back faster. Oh boy, have we seen that, right? I mean, that is, in a nutshell, what we've seen from platform businesses. I mean, it's really just a beautiful thing to see. So, because, honestly, if I had just prescribed this and said, yeah, if I just make that statement, they retreat the least in a downturn and they bounce back faster, you'd say, yeah, well, everyone says that. But no, actually, here's the data. Here are the numbers. It's real. And, a lot of people have put money into this thing and, are benefiting from it. So anyway, full disclosure, we, have worked with WisdomTree on it. We license data to them that helps them make this product and have this instrument function. But long story short, is Airbnb too high? I think it is. Is DoorDash more realistic? Yes. Are platform stocks in general high? Yes. Is there madness happening in the markets? Absolutely, because the Fed has printed over $7 trillion and we've never seen anything like this ever before. Is now the right time to invest in the markets or not? That's up to you. I can't predict the future. I can just tell you relatively between these two things, DoorDash is much more appropriately priced than Airbnb. I think that's pretty much for certain. So last topic here is the Facebook antitrust stuff. So this came out, lots of different stories on this, but there's basically two complaints here. There's a suit filed by the FTC, the Federal Trade Commission, and then there's a suit filed by 48 different states and attorney generals. They are arguing a lot of the same things, that Facebook has abused its monopoly positioning, particularly in acquiring Instagram and WhatsApp for $1 billion each, roughly, and that they use their positioning to be anti-competitive, to thwart other competitors, to somewhat bully these startups into getting acquired, and they need to be broken up. I would agree that content platforms and many of the large platform monopolies, particularly Facebook, Amazon, Google, and Apple, are absolutely monopolies. That is easy to prove if you have a skilled attorney and an informed litigator, which unfortunately many of these people don't fit that definition. These lawsuits, though, if you break up Facebook from WhatsApp and Instagram. Is that actually going to change Facebook's dominance? Is that actually going to solve the problem? And what I want to show you is the number of DAUs that they have by platform. And, they'll break this down between, Facebook and Instagram and WhatsApp. Number of top social platforms by active users in millions. You can see Facebook, WhatsApp, Instagram versus Twitter, LinkedIn, Snapchat, and Pinterest, right? So what they've been able to do is take their dominance and their network effects in the core platform business. Let's call that the social network of Facebook. And then you've been able to see them kind of now supercharge these adjacent platform businesses. WhatsApp really being a communication platform, Instagram being kind of more like a content platform, frankly. Social networks and content platforms can, share a lot of similarities. Facebook.com actually, I would say now exhibits both models. But Facebook earlier, if you actually probably back up more so to when they acquired Instagram, Facebook was really more of a social network than it was a content platform. The thing that really made Facebook become a content platform was when you started to have more of this kind of one-to-many relationship, right? Where businesses and other users could publish information to a myriad of different followers. And you kind of had that single opt-in model, that following model versus the double opt-in, which is that friending model, right? That was really Facebook's original model. I mean, there still is that today where you have friends, but now you can have double opt-in where, I friend you, you accept, and single opt-in, which is the follow model. Follow model is really more regularly followed on Instagram, and Facebook still has the friending, kind of the double opt-in. You can be private on Instagram, and now, there's hybrid approaches to this kind of stuff. But I think you get the point. It's a combination of these three different businesses we talk a lot about on the show, this idea of platform conglomerates, where Uber has that with Uber Eats or Uber ride sharing was the core, and then they got Uber Eats. And now, fortunately for Uber, they've had Uber Eats really actually eclipse the volume in ride sharing just given COVID. That is a very critical point of evolution for these platform businesses on their journey to monopoly power, is when do you cross that chasm to not just have one platform business model, but multiple? Clearly, you look at any of those big four, Facebook, Amazon, Google, Apple, they've got multiple platform businesses that stack on top of each other. And now, that is ultimately what these attorney generals are trying to get at. The challenge is, if you got over 2 billion users on Facebook, just .com, how do you solve that problem? And by splitting up these companies, does that actually solve the problems within each of these ecosystems? Certainly, Facebook has been able to use its platform conglomerate status to supercharge these other adjacent models in WhatsApp communication and Instagram content. And they're about to layer in commerce, right, with the customer acquisition they just made. And the answer is no. Splitting these things up won't solve the problems that exist within the platforms themselves. And each of these in and of themselves are now massive businesses. So does breaking them up, quote unquote, help in the sense of it weakens Facebook's position if you're able to somehow magically be successful and break these companies up? Yes, it does, because now they don't control three, they would control one or two. But at the same time, will you be successful in fighting this case for years to actually break these things up? And I think, you got to look at the merits of the case. I'm not a lawyer. I just know platforms pretty well. And I think that's an uphill battle. Waging the argument to go back and say, well, they shouldn't have been able to acquire this. And now, because they own these companies, because they own Instagram, because they own WhatsApp, that is making them disadvantage their users more. But how are they disadvantaging their users? That really should be at the crux of these cases. And when you look at that, the main way that platforms take advantage of users, as I'm a broken record on this show sometimes, is they take advantage of suppliers, of the creators in this case, right? We've talked about that. We had Tim Kendall on the show from early Facebook, first head of monetization and elsewhere. And there's two parts to this. There's the matchmaking and the algorithms that determine what content goes into your newsfeed. And then there's the curation, right? And what penalizing action do I take on users that post infringing content, right? And both of these things deserve a look by regulators and by the FTC to help regulate. If you think back to AT&T, right? AT&T was a government granted monopoly which had government oversight, right? It was a regulated monopoly, right? And one of the arguments that these lawyers, these different attorney generals and the FTC make is that, if you kick people off the platform, you are disadvantaging them. That's true. But again, by breaking them up, do you solve that problem? No, you actually don't. The problem is, well, what is the role of the platform to be able to kick you off? And if you are kicking people off, if you're modifying their content, if you are, suspending them unfairly, is that a violation of free speech? I think it is. And, that really is where government aggressively needs to step in. So government right now is kind of just it's like whack-a-mole, right? Everyone's trying to chase a different path. The irony is that no one is actually chasing this path, which is to say, these are monopolies by definition. Name of the book, name of the show. They're monopolies. How can we better regulate the operation of the monopoly? And you got to look at these two things: matchmaking and what we call rules and standards, right? So how do you curate usage on the platform or curate access to two mechanisms there? Talk a lot about it in the book. And, the last note I'll finish on is, in general, these content platforms have gotten way too restrictive, way too aggressive with that rules and standards, with that curation of usage on the platform, to some degree that you could probably call them fascist, which is just such an unfortunate irony in so many ways. But this is why. This is now YouTube's latest announcement that you can't talk about the 2020 election being fraudulent, right? And if you do, we can kick you off. Yesterday was a safe harbor deadline for the U.S. presidential election, and enough states have certified their election results to determine a president-elect. Given that, we will start removing any piece of content uploaded today that misleads people by alleging that widespread fraud or errors changed the outcome of the 2020 presidential election. If you talk about this, not only could it go down, not only could your videos be taken down, but your account could be threatened. You could be, deplatformed and all these kinds of things. This is not the value prop of platforms. It's not what they're supposed to stand for, right? The platform is not supposed to regulate speech in the way that these companies are. And Section 230, does not give them the protection to do that. The irony with removing 230, which we spoke about on the last episode, is that it could actually force more aggressive curation of free speech on the platforms, because now the platforms are liable for what is said on the platform. It's really tough to get a silver bullet here, on what to do, again, when so many in government don't understand how these things work. Except for the EU seems to kind of be on the right track here. But the US is just so far away that it's kind of like, just a very blunt approach. It's just like, yeah, let's just try and hurt the platforms and deal with the consequences later. Yeah, let's kill 230. Yeah, let's break them up. They still are monopolies, and you're still not actually solving. You're hurting the business. Right? You will absolutely hurt the tech monopolies if either of those things come to fruition. But there will be a bunch of unintended consequences. And there is a much more, there are ways to do this with a lot less collateral damage this being rein in the over aggressive, unprecedented, violation of our civil liberties that these tech monopolies are infringing upon, without just kind of scorched earth laying waste and damaging the rest of the tech community that is trying to compete against these platforms. And we are seeing ways like a Rumble and other places that are creating alternatives to these content platforms that are particularly in question. We are seeing ways that marketplaces, product marketplaces, are competing with Amazon and having success. There needs to be a role for government in this, but unfortunately, the government has not, whether it's the executive branch, the judicial branch, the Department of Justice, they just really haven't been able to figure out how to thread the needle. They clearly don't watch the show well enough. Otherwise, we'd be well on our way here. It's just, it's quite unfortunate to see. So we'll still be on YouTube, but we will be actively promoting our show elsewhere. So I will leave you with that. Thank you very much for joining us, and we'll talk to you soon.